Hi, everyone. Thanks for joining us today. My name is Sammy Rose, Marketing Manager here at BizEquity. We're going to give everyone another minute or two to join before we start. All right, we'll go ahead and get started. Again, my name is Sammy Rose, Marketing Manager here at BizEquity. I'll be your host today. And our presenters are Scott Gabehart, Valuation Officer, and Ryan Thompson, Valuation Analyst. Scott, I'll pass it to you.
All right. Well, thank you, Sammy, and welcome everybody to today's webinar. It will be a whirlwind tour about business valuation and how it changes over the life cycle of a business. And don't want to belabor our backgrounds, but I've basically been a business appraiser or middle market specialist for close to 30 years. And Ryan Thompson, like myself, is a certified valuation analyst, and he's also a CPA. And we'll be splitting the presentation today as we see in the outline slides. Part one is my domain, and we'll be introducing the perspectives related to being an advisor with business valuation capabilities before starting in on a discussion of valuation methods for startup types of scenarios. And then part two will be Ryan's presentation looking into the more traditional valuation methods as applicable to established businesses. So kind of a big picture start. Although we'll be addressing business valuation use cases over the life cycle of a business, we're doing so from the perspective of advisors, and in particular financial advisors, wealth advisors, CPAs, insurance agents, etc. And the essence of our presentation will revolve around the notion that having knowledge about business valuation will elevate any advisor's standing among all advisors, and it offers the opportunity to literally become the quarterback among advisors, which of course allows you to improve your relationship with your clients, gain their respect and loyalty. And so I like to look at business valuation from the perspective of advisors as an investment. It's an investment of your time to learn the basics of business valuation and utilize that, leverage it in building your client relationships. And next slide, please. So the very concept of a life cycle for a business is quite varied. And if you were to do a Google search for business life cycle, you would see almost an endless array of breakdowns into different phases, some simple, some more complex. Today, we're breaking it down really into two main categories: the launch, startup, and growth phase, which is what I'll address, and then the maturity, decline, exit phase, which Ryan will be addressing. And of course, as with most things in life, you can make any given concept as complex and complicated as you want, and there are many life cycle presentations that are more amenable to breaking out the startup stages of a company: seed, first stage, or Series A, B, C, etc. But we're going to keep it simple as per this particular simple life cycle. So in introducing and discussing the concept of using business valuation as an advisor, it's obviously a valuable and helpful way for any advisor to specialize vis-a-vis other advisors. And of course, that's the wheelhouse of BizEquity. We're geared primarily towards supporting advisors. And as I mentioned earlier, I think if you look at your involvement in learning about business valuation as a long-term investment, there's no doubt that it will provide ample long-run returns in many different ways. And in so doing, it will compel you to think and act more like a business owner, focusing on growth and profitability issues with your clients. And I think many people believe that business owning clients are the best clients. They're the most profitable in the sense that they tend to have greater wealth currently and in the future. And there's a mechanism for driving retention by being actively engaged with business valuation as a service. Next slide, please. Now, in a perfect world, this relationship would begin at the beginning of a company's life, and of course that doesn't always happen, and in fact it probably rarely happens. But the best place to begin planning with a business owner vis-a-vis business valuation is always right at the beginning, because even these documents, the articles of incorporation, operating agreement, they will contain important elements of shareholder rights, restrictions, and the number of shares, types of shares, all of which ultimately will have some impact on per share values or minority interest values as you later develop buy-sell agreements or get involved in gift and estate tax planning. Next slide. And interestingly, COVID has had many effects on everybody's lives around the world. And one of the more interesting outcomes, I think, has been what you might call a surge in the number of new business formations. So as this slide suggests, one surprising phenomenon that came out of COVID was the rise in business applications as tracked by the Census Bureau. And it wasn't just a little increase. It went from 300,000 a month up to close to 600,000 a month, and stayed well above the earlier level into and throughout 22. So that tends to bode well for the future business clients, for advisors of all types. Next slide. Now, getting more into the details of such a relationship, focusing on small business owners. It can be used to assist with procuring insurance of different types. You will become more engaged in understanding the performance of the business and actually potentially becoming an advisor in terms of optimizing business value over time. It will facilitate in any type of transition event. Maybe one key shareholder retires, or even the business is sold. Business valuation will be in the mix, and therefore we at BizEquity can help you cement that role. Now, let me just quickly say that the BizEquity tool, as it exists today, is generating what we call a 100% controlling interest value, which means we're valuing the entire company, all the shares, all the partnership interests, all the LLC units, whatever they are. And as you know, when it gets down to individual shareholder transactions, whether it's gift and estate tax planning or stock option grants for employees, it's the minority interest values that matter. And long story short, a 10% interest in a business worth $1 million will not be worth 10% of $1 million. It'll be worth something less than that due to discounts for lack of control, lack of marketability, and possibly lack of voting rights. And I'm happy to announce that we are getting very close to introducing a new module in the BizEquity system that is specifically geared towards providing value estimates for minority interests. So if you're in any of those situations, you'll be able to apply discounts for lack of control, discounts for lack of marketability, and hone in on those minority per share values. So we're very excited about that, and that should help out many of our advisors. Next slide. And obviously, as I've been saying, business valuation can and should be a central role in your relationship with business owning clients. You're not only providing a scorecard, so to speak, to evaluate your client's company's financial progress. You're doing so at a much lower threshold of cost and time for the client and even for the advisor by using the BizEquity tool. And effective business planning, value optimization requires some business valuation knowledge, and that goes back to that investment of time and energy into business valuation to enhance your capabilities. And along those lines, let me make one other kind of announcement. The BizEquity moniker has always been discover, monitor, optimize. It's on our webpage at the bottom, and we've obviously addressed the discover, meaning discover a business's value. We've addressed the monitor the business's value by repetitive valuations over time, but to date we haven't taken on the optimize component. That is one of our top priorities for the next year, to build into our model and system an optimization component, which would include some things like scenario planning, and even perhaps more important with respect to some of the discussions that we'll have shortly about startup valuation methods. We're going to incorporate a discounted cash flow module to, again, just further round out the depth and quality of the BizEquity offering. Okay, next slide. And if you don't want to take it from me, Warren Buffett has often spoken about the importance of understanding business valuation, and he has said if business schools could offer just one course, it wouldn't be any of the classes that are routinely taught now, modern financial theory, but it would be business valuation, the heart of investing and risk management, and without it, you are blind. So that's a pretty good advertisement for the importance of understanding valuation, and we feel that it's a good way to go for our advisors. Now, getting into the valuation discussion over the life cycle of the business, it's helpful to consider business valuation as a collection of valuation worlds, valuation realms, and they're all a little bit different, but then they also all have some tremendous similarities. But there's a significant difference between doing a startup valuation for a pre-revenue company versus doing a business valuation for a business purchase using an SBA guaranteed student loan. So there are similarities and differences throughout these value worlds, but that's part of getting in and educating yourselves on business valuation and learning to walk the walk and talk the talk. Next slide. So Ryan is going to address this in more detail, but just for perspective, if you are valuing a going concern, you're basically using valuation methods from one of the three primary approaches. And these approaches are the same as what are used for real estate: income approach, market approach, and the asset approach. But I'll leave that discussion for Ryan, and we can go to the next slide. Big picture comments about business valuation, which are, I think, always a nice refresher for anybody who's dealing in the world of business valuation. And that is, for example, the fact that every business valuation is an opinion. It's not a hard and true fact, a provable quantity. It's an opinion, but it's an opinion based on knowable and agreed upon facts and generally accepted business valuation principles and procedures, which the BizEquity algorithm is reflective of. But in a related vein, there is no such thing as the value of a company. And the reason is that there are many different types of value, and values change over time. Some of the major or important differences are, for example, the difference between an asset sale value and an equity value. The asset sale value is very definitional and reflects the value of the inventory, fixed assets, and all the intangible assets: goodwill, covenant not to compete, trade name, etc. But the asset sale value does not account for cash, receivables, or liabilities. That's where the equity value comes into play. And so there'll be different values depending on what's being valued. There'll be different values depending on the standard of value. Fair market value is the value to a hypothetical buyer. Investment value is the value to a specific and known buyer. And then to top it all off, every valuation method from every valuation approach will be based on myriad assumptions layered throughout the analysis, such that if you hired 5 appraisers, gave them the same fact pattern, the end result would be a mean value around which the variance would be plus or minus 10% or even more. And that's just the nature of the beast. So in this world, as an advisor, it becomes important to recognize all of these imperfections or distinctions, but at the same time, in a transaction setting, for example, the more you know, the more you can make your case to support your proposed value, whatever it might be. Next slide. So, startup or new ventures require unique perspectives and methodologies. It will often depend on understanding promoters or stock promoters, people who are involved in actually pushing the stock and promoting its growth. But almost always, it comes down to evaluating the management team, their vision, the market potential, technology, competitive forces, et cetera. So there's a much greater subjective element in valuing startups. And they'll be used to typically raise capital via debt or equity. And they tend to be the domain of angel investors, venture capitalists, and private equity firms. And even key employees, to the extent that they'll be offered stock options at the very beginning of a company's existence. So some of the potentially unique factors as compared to established firms would be, of course, minimal history, perhaps no revenues, even negative profits. It may be a very unique company, so such that there aren't any good quote-unquote comps, and the amount of information available may not be as thorough as you would like, which could include some speculative or aggressive projections. Next slide. Above all else, these startup companies are operating within a high-risk environment. And high-risk environment means a higher discount rate when you're valuing those future cash flows. A higher risk means a lower multiple would be applied, or a lower capitalization rate. And as I mentioned, there's a great amount of subjectivity in evaluating these startup companies because there's not as much to sink your teeth into. It requires diligent, situation-specific considerations. Many methods have evolved to address startup valuation, and we don't have time, of course, to go into all of them, but I picked a couple to just give you a feel for what they involve. But if we go to the next slide. The first Chicago method is one that you'll see bandied about. And ultimately, the first Chicago method it is a DCF method, discounted cash flow method, in most applications, which means you project the future cash flows accruing to the owners, the equity interests, and then you discount those back into present value. And then at the same time, you're assuming an exit after 5 years, and you apply a multiple at that exit year, and then discount that value back into present value. With the distinction being that the first Chicago method is based on modeling 3 different scenarios. So the next slide. Well, this slide illustrates that the first Chicago method is actually a combination of an income approach method and a market approach method. The income approach component is the discounted cash flow projections, future cash flows available to the shareholders. And the market-based approach is applying an exit multiple to calculate what's called the terminal value, and then discounting that back into present value. But the next slide illustrates kind of the hallmark of the First Chicago method, and that is that you don't develop just one forecast. You develop three forecasts. One base case, or maybe most likely case, and then one on the upside, one on the downside, and then based on whatever analysis you can do, you assign weights, and then you end up with a weighted valuation that reflects those assumptions. But it's basically a DCF model using three different case scenarios. Next slide. The scorecard method is what you would refer to as a market approach method, basically. And it's based on comparing the company that you're valuing to other similar angel-funded startup ventures. So basically, you want to somehow go out and find similar stage investments in similar companies and list those values, and then go in and compare your subjects to the group of comparables based on various factors, which we'll see on the next slide. So at the top here, we see the comparables that were located, and there are various places that you can find those comps for similar stage valuations. But in this case, the average of all those comparables was $2,725,000. So from there, you evaluate the subject investment. Look at the management team, size of the opportunity, product, technology, et cetera, and then you weight those factors based on assumed importance, and you end up adjusting that average comparable value up or down depending on the relative strengths and weaknesses of the target. So that's just another example of a startup valuation method that obviously is fairly subjective, but somewhat grounded in market transactions involving similar stage funding events. Okay, next slide. There's a very interesting report that I would encourage all of you to consider buying. It's not expensive. I think it's like $125. It's published annually from Pepperdine University, and it's called the Capital Markets Report, and it's based on, importantly, survey data. So they go out and survey hundreds and ultimately thousands of angel investors, venture capital firms, private equity firms, investment bankers, business brokers, business appraisers, and they come up with all kinds of really interesting, intriguing, insightful data. And the next slide gives us some of the results when it came to angel investors. And of course, angel investments are typically small at the very beginning, at the seed stage, anywhere from 25,000 to $1 million. And I have some statistics that I'll show you momentarily to give you precise insights. But note that about a third of the respondents are basing their valuations on gut feel. And that, again, that's just the subjective nature of startup valuation. When multiples were used, you can see that revenue multiples were the most prevalent, and that would be largely because there may not be any earnings or EBITDA, but there could be some revenue. I think that's good for now. Of course, you can come back and review these additional details, or actually go look at the report online. I think you can actually download the historical reports free online. Let's go to the next slide. So here is one of the many tables that they created for angel investor sentiments. So You can see that as you go from seed to startup to early stage to expansion to later stage, the size of the investment rises, the average revenue multiple rises, but the percent of equity being purchased falls, which is more or less what you would expect. But you can see that at the median, the investment amounts are pretty small, and the revenue multiples are between 2 and 3 times. Next slide. So these angel investors again were surveyed, and here we see again that roughly a third based their valuation on gut feel. Beyond that, they use discounted future earnings or discounted cash flow, capitalization of earnings, guideline transaction method, kind of a typical array, but gut feel, of course, is the most interesting outcome. Next slide. So moving up the scale, so to speak, from angel investors to venture capital investors, the valuation methods that they're using are first and foremost last round of financing, which means they base their valuation today on what an actual investment that was made within the previous 6 months. And obviously, if there have been major events that unfold in those 6 months, that may not be a viable way to go. But there are many times when a different valuation is needed for a different reason 3 months later, and they'll just look to see, well, what did somebody pay? And was it an arm's length transaction? And if it was, well, that's a good estimate of value. Next in line is the VC method, or discounted expected exit value method. And the venture capital method is basically a quasi-discounted cash flow model where you're projecting the terminal value at the time of exit and discounting that back into present value. And there's obviously much more to it than that, but it's essentially what I just described. And even venture capitalists are using gut feel 14% of the time. Next slide. And when venture capitalists are using multiples, 63% of the time they're using a revenue multiple. So again, same notion. Even venture capital firms, when they get involved, there may not be substantial earnings or EBITDA. And as a result, they are almost forced to rely on using revenue multiples. And then various cash flow earnings multiples are used as well, but to a far lesser extent. And then the next slide takes us into the realm of more established businesses and investment banker survey data. And you can see the valuation methods change completely, whereby the main method is a guideline company transactions method, which is to say they're looking at what did other similar companies sell for, essentially. And then also capitalization of earnings. I'm pretty sure that second one would be discounted cash flow. I don't see that they put a title there, but I'm pretty sure that's what that would be. So a multiple period discounting method, or DCF, discounted cash flow, is a common method. And then a capitalization of earnings method is actually just a subset of a discounted cash flow model, where you're only projecting 1 year of data and then capitalizing that estimated value. And in terms of multiples, when they do use multiples, of course, we switch completely from revenue to recast adjusted EBITDA multiples. And adjusted EBITDA is essentially similar to what we call discretionary earnings in the BizEquity module. But clearly the earnings take over, the cash flows take over once companies are established. Next slide. And I included this just to give you a rough feel for some of the average multiples that are out there. And this was a survey at the end of 22. And of course, what you see in every single one of these columns or industries or types of businesses is what we call the size effect. The size effect is one of the most important components of business valuation. And it is simply the case that as a company's earnings rise, the multiples rise. So Main Street companies like downtown, small town, downtown restaurant, maybe two times, 3 times discretionary earnings. But you get into a middle market manufacturing company, then you're talking more like 3, 4 to 6 times discretionary earnings, and even higher. And then, of course, the largest companies of all are the publicly traded companies, and they're selling now for something around 23, 24 times after-tax profits. So it's basically higher, greater earnings, higher multiples. And that is seen pretty much across the board in all these different types of businesses. Okay, next slide. And I'm going to close with a discussion of what they refer to as the valuation gap. And basically, the investment bankers were surveyed as to why did their businesses not sell. So over the course of a year, they get 20 businesses to sell. They may sell eight of them or 6 of them. And when you ask why did they not sell, what happened, what was the problem? The number one issue was a valuation gap in pricing, which means that either the buyer thought the asking price was too high, or the seller thought that the offer value was too low. And this is where where negotiations obviously become important, and you can't effectively negotiate a optimal deal price if you don't understand the basics of business valuation and are capable of making your case. And obviously, investment bankers are, in most cases, capable of doing that. But it's just intriguing to see that the valuation gap was the main reason why the deals didn't sell. And in terms of the size of that valuation gap, you can see that 8% were between 1 and 10%, a small gap, and so on. You can interpret the chart, but it's not a small gap. And the main point here is that the more you understand about business valuation, can talk the language, walk the walk, talk the talk, the more you can help whatever side of the transaction you might be on. All right. And now I'll turn it over to Ryan Thompson.
All right, and thanks, Scott. Really good information there around valuation and in the startup phase. But kind of building off that, naturally, a business that survives the initial startup and growth stages, it's going to move into a more mature or established realm. And there's no obvious or definitive line that you're going to cross, between a startup and maturity phase. However, we can look to certain characteristics of the business to determine, if it's in this stage. So one sign of a mature company is that the patterns are going to begin to emerge and be stronger. and the company's metrics are going to be more predictable. The company's growth patterns are going to be more consistent over the long run, and revenues and expenses are more stable, and the profit margins are going to be a lot more static. And additionally, these companies tend to have a strong and recognizable brand. Customers are going to be placing more trust and into the brand, and they're willing to pay a premium for the business's products and services. And then depending on the nature of the business, they're also likely to be a higher percentage of repeat customers who continually come back and purchase the goods or services, and potentially even recommend the company to their friends. Another feature is an experienced management team that has been with the company for a long time. At this level, the leaders have a deep understanding of the business and the customer base, and they're going to be able to make those strategic decisions for the company. And then a final indicator here is strong financials for the company. So obviously, like we said, a mature business is going to have steady growth. They're also going to have consistent profitability and a healthy balance sheet. They might have multiple different revenue sources that are well established, and they're able to generate cash flow that can be returned to shareholders and reinvested in the company. So, a little bit different than some of the approaches that Scott just went through. Once companies reach this maturity stage, the methods tend to get, a bit more conventional than the early stage companies. And, Scott touched on these briefly as well, but, understanding as an advisor and a business owner can be, pretty helpful, with clients that have mature businesses. So as the company progresses out of these stages, we're going to fall back more onto these traditional approaches: the asset approach, the income approach, and the market approach. However, for the majority of mature operating companies, they're most likely going to have steady cash flow and be operating as a going concern. So that's going to make, for a majority of cases, the asset approach a little less relevant. So the asset approach in those cases is generally considered the floor value, because it doesn't really take in the future earning potentials of the company, which is a pretty key factor in determining value. As we move into established companies, that focus is going to shift more toward the income and market approaches. Under the income approach, the two primary methods are capitalization of earnings and discounted cash flow. And just like Scott said, a DCF method essentially computes cash flow into the future and then discounts it back to today. And this method, even with mature businesses, could still be used, but it's more common when management expects fluctuations in the business, or when valuing those startups or high growth companies. Under the capitalization of earnings method, the business is essentially, the value of the business is essentially estimated by dividing its earnings by a cap rate. And that cap rate reflects a rate of return required by investors to invest in the business. And this method is used when the company's earnings are expected to be more consistent. And for most mature companies, this is going to be one of the preferred methods. And then finally, we have the market approach, which tends to be a more user-friendly approach, with the idea here being that you could take a business and look to and reference reasonably comparable guideline companies or comparables that for which the actual transaction values are already known. And this concept is very similar to real estate, where you might price your house based on what your neighbor's house sold for. So with a company, there might be a similar company to yours that sold for 1 times revenue, and you see a sale of that. So it could follow that your company could potentially sell for that as well. And then another good thing about the market approach is, as these companies reach maturity phase, the number of comparable companies starts to expand, right? When you're in that startup phase, you're a little bit more differentiated, and then as you grow, there tends to be more companies that at least could have some similar characteristics to you. So with a better understanding of these methods, we can take a look at how valuation can be leveraged over the business lifecycle to meet the goals and needs of the business owner. So as the business becomes more established, its reasons for requiring a valuation become more dynamic. It could be that the owner wants to review their insurance coverage. Maybe they're planning to, gift a piece of the business, or just spot check where the business currently stands. Regardless of the issue, understanding a business valuation can, assist in numerous events over the life cycle. Another important thing is, over the next 2 decades, it's expected that trillions of dollars are going to change hands as baby boomers exit their business. And advisors who understand the needs, the business owner clients rather, and understand the aspects of business value are going to be able to better position themselves, to assist those clients who are exiting, as well as those who are going to be inheriting those businesses. So, over the next couple of slides here, we're going to provide a high-level review of some events that might necessitate a valuation of the business. So first being, some buy-sell insurance. So, once owners reach a certain level of maturity, once the business does rather, they're going to switch, the tone a bit from when they were a startup, and things are going to slow down, and they're probably going to make sure they have the proper risk mitigation efforts in place. So, part of that might be, reviewing the buy-sell agreement. Typically, these are set, early on in the company, but a lot of times they fall to the wayside, and owners don't revisit them. However, as the company grows, the value is also going to grow. So whatever value was, originally set to fund this buy-sell agreement might want to get visited, periodically, especially when there's material changes to the business. A few other here that can be tied to the value of the business. Again, disability buyout insurance. So, the business owner may already have a buy-sell agreement that's set up and clearly indicates, how the shares are going to be repurchased when the owner passes. But what happens if an owner becomes incapacitated from a long-term illness or injury before that? Well, the disability buyout insurance funds the buy-sell agreement to buy out a totally disabled owner. And again, it can help with less disruptions to the operations of the company. And it's important to periodically review that buy-sell agreement and the funding vehicles to ensure they're keeping pace with the current value of the business. And again, overhead expense insurance, that can pay a benefit to help, cover operating expenses such as payroll in the event that the owner can't work. And while this isn't directly tied to the value of the business, periodic business valuations, as part of that, you're reviewing the expense levels of the company. So it can help ensure that, you're choosing the appropriate coverage amount. So possessing an up-to-date valuation helps owners purchase the protection they need without overspending or underspending. And advisors have a clear opportunity there to provide some valuable guidance to their business owning clients about the importance of insurance and those coverages. Again, as an advisor with business owning clients, your client might be looking to expand the business. And once a business reaches a mature level, someone can fall prey to complacency and take for granted that the business will continue to have consistent results in the future. One way to keep ahead of that stagnation is, a continued focus on evolving and growing the business over time. And mature businesses will generally need to look as to whether they're doing internal growth or external growth to expand the business. With internal sources, the business might seek to offer new products or services or focusing on capturing a greater market share. Established companies might find it easier to grow externally through mergers and acquisitions, M&A. Acquisitions allow the company to purchase another business that is sometimes complementary to their own and access a new market or acquire new customers. Mergers are another common way to grow a company, and they can allow for increased scale and resources. Either way, valuation is a key component in the process when considering the expansion of a business through external sources. So while it might seem obvious, the valuation can provide insight in determining the appropriate price paid for the target company. And it generally involves analyzing the target company's financials, trends, and other factors that provide insight into profitability, liquidity, and debt levels, all of which are helpful in evaluating the financial health of the company. So, with a clear understanding of the company's value and financial health, the acquiring company can negotiate a fair deal that's beneficial to all parties. One thing that's almost certain to come up is gift and estate purposes. So a business is something that an owner might choose to pass down to their spouse, children, or another party. And one study found that as many as 37% of business owners want to transfer the business to a family member as part of their exit. So when an owner wants to gift all or a portion of the business, a formal appraisal, might be required so that they know how much they're gifting and the recipient knows how much they're receiving. One thing to be mindful of is the federal exclusion threshold. So if a business owner gives more than the annual gift limit amount, they're going to need to file a gift tax return with the IRS. I believe currently in 2023, those limits are $17,000 per individual and $34,000 per married couple on an annual basis, and those change each year. And then once the owner has given more than those annual amounts, they begin to eat into their lifetime gift and estate tax exemption. The current lifetime exemption is about $13 million per individual. However, the current policies in place, that's expected to sunset by the end of 2025, and the lifetime limit could drop nearly in half to about $7 million per individual. So that's definitely one policy to be mindful of. For many small businesses, that's not going to be an issue. However, for large businesses, they're going to want to make sure they're ahead of that and taking that, into account for proper planning and mitigating any future tax ramifications. And then another important aspect of gift in estate purposes are the discounts that Scott mentioned earlier, those being primarily discount for lack of control and discount for lack of marketability, which really allows a business owner to transfer more of the business at a lower price. And these can be a very effective tool when planning for gift and estate purposes. So understanding the value, the advisors and owners can work in harmony and plan the right strategy for the client, as well as the timing of any gift. Another thing here, so even when there's no immediate need for a transaction and there's nothing on the horizon, business valuation is still helpful in the client and growing the business and acting as a report card. So performing business valuations can identify strengths and red flags and opportunities for growth, and they can be useful in preparing an effective growth strategy and setting goals for the company. Additionally, valuations typically include some sort of ratio or trend analysis, and certain ratios are calculated, such as debt to equity or fixed asset turnover, which can be utilized to identify the company's internal trends over a period of time. Additionally, the company can use these results of these ratios to benchmark their performance against industry peers, which provides very valuable feedback for how the company is performing. And then having periodic business valuations really acts as a report card for the business. So it's a great opportunity in that it gives owners a fair sense of what their business is worth, which could be different than their expectations. Owners, might overvalue or undervalue their business. So periodic valuations can really give them a frame of reference. And with this, with this business value information, owners can take actionable steps to increase the value of their business, whether it's increasing profitability or lowering risk, and then they can compare these results to their previous results. So it really acts like almost like a quarterly report card, and have self evaluations and ensure that they're on the right path. So it's as far as planning goes, it's estimated that on average 75% or more of business owners' wealth is tied to their business. However, most business owners don't know what their business is actually worth. So this creates an obvious concern, when you're trying to plan for any future needs. Planning and business valuation really go hand in hand. It'd be very hard for an advisor or an owner to have an effective planning process in place without at least a feel for what the business is worth. The Exit Planning Institute estimated that 83% of owners of privately held businesses had no written transition plan. By including valuation in the planning process, an advisor is in a better position to assist their business owning clients, and they can really help increase the long-term value of the company. So evaluation also provides more clarity into the total planning process in regards to timing of an exit or retirement goals. So, it's often the case that the owner has an unrealistic view of what their business is actually worth. If the business owner undervalues the business, they might remain working in the business longer than they should have when they otherwise could have exited, meeting their actual retirement goals. And then, on the other hand, an owner might naively believe their business is much more valuable than it is, leading to distorted retirement goals. So really, just to recap there, an advisor who can understand or at least gain an understanding of valuation is better to serve their clients' planning needs for the future. And then finally here we have exiting the business. So at some point, a business owner is going to exit the business, whether it's gifting through estate, closing the doors, or selling the business. And it seems obvious, but reviewing the business value when selling the business is paramount. Some owners will simply just list their business for sale with a preconceived price without actually giving additional insight. And valuations are helpful because they can reveal areas where the business may be able to improve its financial performance. And by analyzing the business financial data, the valuation process can highlight areas where the business really is underperforming, which can be addressed before you put it up to the market. On that same note, knowledge of the business value also helps determine the best time to sell the business. The seller might realize, by getting a valuation, the value is lower than expected, and they can wait to list the business until a more opportune time. Understanding the worth is really key, obviously, to negotiating the sale of a business and getting a good deal. Without a reasonable expectation of the value, an owner might have an inflated view of the business and inadvertently turn away a qualified buyer, or the seller could not understand a reasonable price that was offered. and accept a lowball offer, effectively leaving money on the table. So, when contemplating an exit, it's useful to consider, a preliminary valuation, which can allow you to get a feel for what the business is worth and give them insights, for the owner to act upon. And really, it gives the advisor and the owner a long enough runway to effectively plan for an exit. So just a couple cleanup items here. So in support of today's webinar, we'll be providing this presentation for you to take a look at, which provides some additional bonus slides around business valuation that we couldn't get to today. And there's also going to be several white papers that can be made available that cover a wide array of topics, including commentary around the 2023 economic outlook and business valuation related material. And with that, I'll pass it back to Sammy for any additional comments or questions.
Thanks, Ryan. Yeah, we'll move on to questions now. Feel free to drop them in the chat. We currently have one question for Ryan and Scott. What approach does BizEquity use?
I'll take that one, Ryan. Well, we are, you could say it's a combination approach, but it is primarily a market approach driven methodology, whereby the industry is selected by the user. So the multiples that we're using come from a variety of the best transaction databases in existence, and so in a big picture, the multiples are industry specific. They're size adjusted, as I discussed earlier. Multiples rise as the earnings rise, and they're company specific risk reflective, which is to say that as the user goes through the 7-step tool, the actual final multiple will be raised or lowered depending on the results. So, for example, there are a number of slider questions. Importance of the owner, the amount of recurring revenue, customer concentration. All of those things will push the multiples up or down depending on the situation at hand. In addition, some of the balance sheet entries will impact that actual final multiple. For example, if the inventory and or fixed assets are greater than the industry norm, that would have a positive effect on the multiple. But in essence, we're using a multiple of discretionary earnings to value most companies. And discretionary earnings is the broadest, most complete measure of cash flow available to a single owner working on a full-time basis. So discretionary earnings are basically equal to EBITDA, earnings before interest, taxes, depreciation, and amortization, plus the actual compensation paid to a single full-time owner-operator. And then adjustments are made in the tool based on analysis to ensure that that owner compensation entry is correct in those cases where, for example, there are multiple owners or a passive owner. So all of that is addressed, and that multiple of discretionary earnings leads to what I referred to earlier called the asset sale value. And this multiple and measure of value, asset sale value, is a generally accepted value quantity that bankers use, appraisers, business appraisers use, and it reflects the value of the inventory, the fixed assets, and all the intangible assets. As I mentioned before, goodwill, trade name, customer base, covenant not to compete, etc. But then we use that asset sale value as a foundation for determining the equity value. And depending on why you're doing the valuation, either the asset sale value or the equity value will be more important. And the equity value is broader in that it reflects the value of all the assets, all the liabilities, known and unknown, and specifically, it incorporates the cash, receivables, other liquid financial assets, but then also backs out the liabilities. But so we're primarily a market approach driven engine, but we also have a kind of a quasi discounted cash flow component for high growth, high profit companies, which is incorporated into our growth sliders. And then, as I mentioned earlier, we're as part of our work on the optimization component of our system, we'll be developing and incorporating a discounted cash flow model, which will be available as well. I'm not exactly sure when that will be, but it's on our roadmap. So primarily market approach method based on 5-digit NICS codes and transaction data from the leading transaction reporting service in the world, but also an income approach component.
Great, thanks, Scott. One more question here before we wrap up. Why would a business owner use BizEquity instead of their accountant?
Ryan, do you want to take that?
Yeah, I think, they could, it's not to say one or the other. It's, you could use your account in some ways. Obviously, some people are going to be comfortable with that, but I think the tool also provides a different perspective, right? It's more of a software, driven capability, and it can get to, a couple different estimates of value, so you can see a few different things. Now, typically, accountant might, they might be able to come up with one value. They could calculate them all, but their resources, unless they're business appraisers, are likely more limited. They might not have access to the same, ratio databases or industry multiple databases. So the result could be a bit different. And then it also depends if the CPA, is a, ABV with the AICPA or some other sort of credentialed valuation analyst that, could really get the job done.
And I think it's important to state that BizEquity is not a tool that you can use to support an estate and gift tax return. It's not a full and formal appraisal as required by the IRS, but it's incredibly accurate, and I say that based on the fact that we now have thousands of users and hundreds of financial services companies that have all vetted, tested, poked, and squeezed, and looked at endlessly, and they came to the conclusion that it is accurate within the sense of what I described earlier. Valuation is an opinion. It's an art and a science, and there is no such thing as the value, but it's incredibly, surprisingly accurate for a software tool, but not so surprisingly to me, because it is essentially mimicking what I would do in most cases in performing a real world valuation of an operating company.
Great, thanks, Ryan. Thanks, Scott. So to wrap it up here today, we will follow up with the questions we didn't get to live. There will be a follow-up email with the presentation and content after the webinar concludes. Any questions, feel free to reach out, and thank you for joining us today.
Okay, thanks, Tammy. Thanks, Ryan.
Yep.
And thanks to everybody for joining.